And we are live.
There
All
we go.
right. Yay. We are live on Facebook, LinkedIn, and YouTube. So all platforms are going well. This is our episode 7. We are on an off day today. We're on a Tuesday, and that's because this week is Thanksgiving, and we want to make sure that not only you, but also ourselves, we want to enjoy our Thanksgiving with our families. And we want to wish you all a very happy Thanksgiving as well. Again, good morning, friends. Thank you so much for joining us. For those of you who are returning, we so appreciate your support and always following us. Welcome back. For those of you who are just joining us for the first time ever, put a thumbs up, give us a high five, and just so we know that you are new. And we really appreciate you joining us today. So again, I always encourage you guys to, whichever platform that you are watching us on, to please like the page or subscribe so you can see when we go live. And when we do schedule the live sessions, and sometimes if we have a change in schedule, so you will be aware of it. So the usual schedule, as mentioned, is every Thursday, 10 a.m. Eastern, and all these 3 platforms, Facebook, LinkedIn, and YouTube. So don't forget to subscribe. Just a quick introduction. My name is Marie Torossian. I'm a certified public accountant and a chartered global management accountant. I'm an experienced auditor and a CFO. Currently, as a CPA advisor and transformation coach, I use my valuation MT framework that I've created using my past experiences to help businesses go from their first million to the next 10 million and more. I've written a couple of books, and one of them is a free ebook available to you, and it is in the chat. You can go ahead and click the link and then download that. It's free to you. You can also read my newest book, The Complete Guide to Business Growth, and that is available on Kindle. So without further ado, I have my guest and my partner in tax. He does all the tax filings, and he's also the main person with the tax planning, and that's the conversation today we're continuing. So Pedro, please introduce yourself. Thank you so much for being here.
Good morning. Yes, I'm Marie. And sorry, my name is Pedro Gonzalez, business and tax strategist, and pleasure to be here. Myself, I have an ebook that I have released. Many people have given some good feedback on it. Is the Real Estate Investors Tax Strategy Guide. It is free. But I like every other freebies out there. I think it's good information. I believe the link is available, and you can get it and have access. I think a lot of information there is applicable, not only to real estate, but you're going to find some good information there for the general public. So we're also working on the tax-wise program to educate and help our clients to reach a level, what we call the 10% class. We believe that 90% of the people really have no clue about the tax and how to play the game, and that's why they're getting hurt in the process. So we want to help you is to reach that level where you understand the rules of the game, so you can really maximize and achieve your financial goals.
Yes, definitely. And with we've already in the past few weeks we've been talking a lot about the tax situations, because with the year coming to an end, this is a big conversation that happens with most business owners and the general individual taxpayers as well. We know we've talked about self-employment taxes, we've talked about the tax due dates, we've talked about some of the forms that they need to use. The last 2 weeks we focused on tax planning. With last week, the main conversation was net worth versus income, the different types of income and how they are getting taxed, how to utilize assets to generate passive income and that type of stuff, right? And then today we wanted to expand that tax planning conversation, because there's so many different pieces that go into that tax planning. And today we were going to focus a little bit more on how we take into consideration the retirement plans and possible investments. So let's take it from there, Pedro. Just walk us through how you would take into consideration the different types of retirement plans. Let's say that whether it's the IRA, the 401k, while you're doing that tax planning. There's the 401b. There's just so many out there. There's the SEP IRA. There's whole bunch of, types of retirement plans that, an individual can really get confused. Even as a business owner, you're like, which one do I do? And which one do I have? Which one do I move? And sometimes we have to understand the tax consequences of all these different changes we're going to do while we work with whoever their financial advisor is, because we're not doing that. We're just, calculating the tax consequence of any action they may take. So I'll let you take over on that one.
Okay, very good. So today we're going to, in essence, give you a beginner's guide to retirement plans.
Awesome.
So we'll go, again, it's going to be general, but I believe, again, you're going to find some good value in this information. So get your notepad and take some notes. Today, again, it will be an overview, but again, valuable. I think it is a great idea, Marie, that we're taking a little bit of time on this because, like you said, there's a lot of people with a lot of questions. This is not an uncommon situation, because, again, a lot of people want the retirement planning. A lot of them have been sold a plan, but they have no idea, one, what exactly they have, how to maximize it, and how to properly utilize it. So again, when you hear all these different names of 401k, IRA, Roth IRA, Roth 401k, I mean, you name it. There's a plethora of different types of options out there, which is a good thing, but at the same time, it can get confusing for most people.
Absolutely.
So again, what we're going to try to do is to kind of give you some general overview, so then at least with the goal of giving some clarity, or at least to help you in that decision making. But before we get started, I just want to again make a quick disclaimer. Marie mentioned it, but I want to mention it too, and that is that I'm not a financial advisor, and whatever opinion I provide here is my own. So I want to make that clear. And again, I don't sell any of these products. We work with very qualified individuals that do the setting up of the plans. So the goal here is, again, will be geared toward more about the taxes and not so much about the performance of each of the investments and so on. So to get started, let's talk about the one is the traditional 401k. I think a lot of people are familiar with that. You're gonna see that typically in larger corporation 401k. So it is a company-sponsored retirement plan. The contributions are made with pre-tax dollars. There's no income limits to contribute. The maximum right now for 2021 that you can contribute is $19,500. It is $26,000 if you're 50 and older.
Yes, to try to catch.
The company it's company matching, and at the time of withdrawal, the funds are taxed as ordinary income.
Correct.
At the billing rate at the time of your retirement. At the time of you starting taking the funds. You're allowed to start withdrawing at 59.5 with a penalty. If you do that before, then there's a 10% early withdrawal penalty. This is going to be common with a lot of these retirement, because again, the goal is for you to set monies aside. It's intended to be a savings account for you to put some money and take it out. The idea is you put it there, leave it there.
Correct.
There's a penalty if you have to. There's exceptions, like a lot of the rules. There's some exceptions, but again, I'm just giving you the general rules. There's also going to be something you're going to hear about it. That is the either referred to as an R&D or required minimum distribution. That's a 72, meaning that at 72, you're going to be required to start taking withdrawal. There's a minimum that you have to take out.
Right. So they can't keep holding on to their money past the 72. So they are required to start taking the money out from their 401k.
Exactly.
Right. So this is the easiest one that most employees that are working for someone else are provided. What I've seen, usually the employee may contribute a small portion, and then the employer will match them with another portion, say 3% or whatever it is. And then, so then basically, to simplify, you are not paying taxes on that money. You're kind of like a savings account, putting it away, saying, I don't have to pay taxes on this money until I retire and I start taking the money out, and now I can start paying taxes. So it makes sense for someone who's anticipating maybe their tax bracket to be lower in the future. Would you say that? Okay.
Yeah. No, it's a great way, including for employees. This is also, again, I'm trying to do something general, not geared
Yeah.
to the self-employed. An employee, for example, can utilize this to lower their taxes. It's a great way for them to defer some of the taxes. If you, let's say, for example, you're making $100,000 in your W-2, that's your normal wages. You can put, let's say, for example, 10,000. That 10,000 now is not being subject to taxation. You're
Absolutely
setting that aside, and then you'll pay the taxes on that 10,000 at a later time. So it's a good option for those individuals that are looking for ways to lower their taxes. Now, the next one is the Roth 401k. Similar, it's kind of the same family of 401ks. It's just what happens in here, just like the traditional 401k is established by the company. It's an employer-sponsored plan. But unlike the traditional 401k, is that the Roth 401k contributions are included in the compensation, as opposed to the traditional. However, since you're including your contributions in the taxable income, then you won't owe the taxes at the end. Compared as opposed to the traditional, when you take the money out, it grows tax deferred, but you pay tax at the end. The Roth 401k, as the same as the traditional Roth IRA, is that you put the monies in, you will then pay, it grows tax free. So when you retire and you're just going to take money out, then it's not subject to taxation at that time. What else I can tell you is that it would allow you, compared to now, if you're trying to compare the Roth IRA and the Roth 401k, is that the 401k would allow you to put more money in the Roth traditional Roth IRA. So this is a way for you to establish a way to put more money aside. If the 6,000 cap is going to be too low for you to maximize your tax benefits, the Roth 401k could be an option for you. What else I can tell you? It's typical. It's similar to the tradition. It's going to have then the penalties. It's going to have the required minimum distribution. The difference is that one is pre-tax dollar, the other one is after-tax dollars. The next is another type of 401k called a solo 401k. It's basically the one participant 401k. That's ideal for the
self-employed, maybe.
Exactly. One person shop, and it's looking for a way that I can put, it allows you to put some good monies aside. So it is ideal for that as a business owner with no employees, and limited also to the spouse. You can include the spouse in this. So that's kind of in general the 401k family. Then the traditional. Now we go into the IRA side. A lot of people are familiar. The traditional IRA, your contributions are made with after-tax dollars.
Correct.
Most people are familiar by now with this. Your contributions go tax deferred. You receive a tax deduction in your tax return for the contributions you make into your traditional IRA. You can contribute $6,000 maximum per year, $7,000 if you're 50 and older. Now the big difference. Let me see. I'm trying to kind of. We talked about the difference with the IRA, the Roth. Now, it is tax deferred. The traditional, the keywords in here, you're going to hear a lot is tax deferred, tax free. Tax deferred is because you are not paying the tax today. You're going to pay.
You're just delaying.
Exactly. And now the Roth is similar to your Roth IRA. Is going to be similar to your Roth traditional. The difference being is that then it's tax free. Now, you get no deduction now when you're making those contributions into your Roth IRA, but then when you take the money out, you don't have to worry about what tax rate is going to be at that time, because again, I didn't receive any tax benefit, and then you're going to get tax-free growth, and at the time, it's not subject to tax. So that's a great tool to use.
Right. So in other words, can we say that with the traditional IRA, we're deferring. So we're using gross dollars, gross from the paycheck. We're taking the money, putting it away, delaying, right, the taxability of it, and then we get a net paycheck, just to simplify. And then for the Roth, we're getting taxed on everything. We're getting a net paycheck. Then we're putting the money in the Roth.
Well, the IRA on both cases, the when we're talking about the IRAs, the personal, the individual established accounts, you're going to have, as an individual, you have the traditional, the Roth. They're both with after-tax dollars.
Ah,
Yeah.
got it. Because I think that's most of the time when I even get confused.
No, and like I said, this is a lot of people have a lot of questions and confusion about this, but the pre-tax dollar is going to be your 401k, because then it's being taken before
Correct.
before any taxation. I mean, so in essence, but in the case of IRAs, the Roth and traditional, you're using your after-tax dollars. I mean, you're taking as the money raised subject to tax. Now, the difference between the two is that one is going to give you some tax deduction now, and you pay tax later. The other one, you get no tax deduction today, which is the Roth, but then it's tax-free. So that's basically, in summary, the kind of a quick way to differentiate between the two. Now we get into another area a lot of people may not be familiar, and that is the Simplified Employee Pension, the SEP.
SEP.
Yeah, the SEP is in essence kind of an easy way to look at it. In essence, like an IRA established by an employer. Is an individual retirement account that an employer or a self-employed individual can establish.
Okay.
So the SEP IRAs are used by small businesses to basically meet their retirement. It's the same, but it's in essence usually used. You're gonna see it. It's usually common with the small businesses. It has kind of lost a little bit of the taste because of other programs, and a lot of people don't mention it anymore. But it's available, and it's a great tool to use. So the SEP IRA, what I can tell you is the contributions are as high, often higher than the standard IRAs.
Okay.
Even higher than the even 401ks were allowed. So the contributions are made by employers and cannot exceed 25% of the compensation, of $58,000 in 2021. So you can see that you can stash a good amount.
Yes, that's a big difference. I mean, from a traditional IRA to the Roth IRA to the SEP IRA, 7,000 threshold versus 58.
Exactly.
That's a big difference. So a small business owner that's making quite a lot, this is a great way for them to set aside money in their retirement and really, wow, that's definitely a big difference.
Yeah, and so it allows so one of the reasons for small business to consider is that it allows for a vesting period compared to some of the other plans, meaning that to qualify, and this can in a way, I don't want this to sound negative, but in essence what happens, and I know a lot of the concerns for employers is, I don't know if Johnny's going to be here long term. So if I make it available to everybody, then I don't know if Johnny's going to be here next year or the year after.
Got it.
SEP allows you is that there's a vesting requirement. That is, like, the employee has to be at least 3 of the last 5 years.
Mm-hmm.
So it's in a way is to compensate, to reward those employees that are in essence committed to working with you. So they can get an additional benefit that you can offer in a way, but without forcing you to give it to them and day one.
Understood.
So it's a good plan for small businesses. It can definitely help, and like you mentioned, it allows you to stash more money into the plans compared to your 401k, including even a 401k.
Oh, of course, yes, that makes total sense.
The other one that I was thinking about, and again, you might have heard about, is the Simple IRA. Is for the smaller companies. You must have 100 fewer employees. The employees have to have earned $5,000 or more in the last 2 years. It grows tax deferred, just like the 401ks. Um, it is funded by through employee deferrals and employer contributions. Now there is a mandatory employee contribution of 3%. See, there's what
Yeah.
it helps in one way, but you gotta
Of course,
consider
there's limitations everywhere, rules that kind of stop
exactly.
you.
And those are it's kind of playing chess. You know what I mean? You're moving
Yes,
slowly, so you got to be careful because then it comes and bites you. You know where in another area, and or something that a lot of times it's not mentioned. You know what I mean? Tell them,
yes,
oh, this is 400. You say, oh, sure, I'll do the simple IRA, but then you might get hit with a 3% matching that you probably didn't, or not prepared to do.
right,
Something I forgot to mention on the SEP, the advantage also that a lot of people like the small businesses is because it does not force you to do contributions in those down years. So again, another benefit of the SEP compared to something like the simple IRA where you'll be forced to have a matching of the employees' contributions. Um, the maximum is 13,500
mhm,
or 16,500 if you're 50 and older. Next, one that again you probably don't hear much anymore. It used to be kind of popular back in probably the 80s and 90s. And the Keogh plan is similar to a 401k. What it is geared towards more of the sole proprietor. A lot of the Schedule Cs, the LLCs, partnerships. Those it was geared towards those, especially because most of them don't pay themselves wages. You know what I mean? Because
correct.
if you pay attention to the other ones, it's subject to the compensation. So what happens to me that I'm, let's say, an electrical
An LLC or sole
exactly
proprietor, right?
proprietor, but I don't pay myself a salary.
Right.
So what
You
do
could be
I
getting taxed on everything, right?
exactly? So then the Keogh plan is a good one for them because then it's kind of it was geared to these individuals and allowing them to set up a way for them to set monies aside. For 2021, you can contribute 25% or 58,000, kind of similar to the SEP.
Wow. Okay. Okay. That's amazing.
So yeah, so there's different options. I guess at the goal, what I wanted to again with there's multiple options out there when you're talking about the
Right.
topic of retirement planning.
Right.
And you can see that the idea it also helps you with taxes. That's why the synergy
True.
between the retirement planning and the tax planning. We're working with our team of financial advisors is coordinating the retirement in a way that can help this individual. For example, the 401ks, a small company that one of the disadvantages of the 401k type is going to be the filing requirement, something that a lot of times is not mentioned.
Mhm.
You know what I mean? It's something that they need to be aware. So would it be beneficial for somebody to establish a 401k as a small business when there's what is called a Form 5500? It's a requirement. You have to file that. Because in essence, you're creating a separate entity, a plan
Mhm.
that then owns this retirement.
Correct.
In that plan has to file a tax return. And that is not a lot of times it's not mentioned. They're not educated because a lot of times the financial advisor be either intentional or probably escapes. Is that they don't mention, hey, by the way, there's this exactly. Then they get hit by penalties, and those penalties are hefty.
Of course, and especially that it's managing other people's monies as well. So it's like,
And so it is hefty, even if in really it's not based on the amounts. That's the scary part because you will think, okay, it's a percentage of the amount contributed in the plan. No, it's a set dollar amount per day. It's like something ridiculous, like I think something like $200 or $300 per day. Do the math. And
yeah, you miss every day filing.
exactly. And let's say you only put there, I don't know, $10,000, You know, it will add up very quickly in penalties. It could be anywhere between $9,000 to $10,000 penalty for it. Let's say that you forgot and
Right.
or you were not told, and all of a sudden you get this nasty letter from the IRS telling you that this is $9,000, $10,000. You're like
what?
talking about? and there's something that, again, to be aware. That's why the selection of the plan and really how much you can put aside. For example, if you cannot put aside $58,000 or $60,000, maybe an IRA where you put $6,000 might be better. Yes, it's simpler. It's less headaches.
Sure.
And doing all the additional contributions and all of that. You see what I'm saying? So all of that, all those different factors come into play, because what we want to do is to help you lower your taxes, but at the same time looking at cash flow and your long-term goals.
Absolutely. I think it makes total sense that while we're doing tax planning, we have all these options available. We're able to gauge with the client based on the type of business they have, how small or how large, how many employees they have, what would be the right fit, what would be the right plan for everybody's sake, and then how much of the legalities they need to fill in, because as a sole proprietor, I don't want to deal with more paperwork that I need to fill out, for example, and then forget something and get taxed for it, so or get a penalty for it. So I think it's important to have the right people that work with business owners. So from that tax planning side, the financial advisor or the insurance agent, that are working as a team to provide all the right solutions, versus each one giving different advice and then no one's talking to each other. And that's where we kind of stand out, because we've created that type of a network with, top-notch professionals. We don't do the insurance agency thing. We just focus on the tax planning and tax effects, but we're actually talking with the right people so that we're providing a group team view and a holistic view and a solution to our clients. So yeah, well, this was definitely a lot of information. So I think what I'd like to do is maybe afterwards you and I can put together a simplified schedule of, let's say, the key things that we talked about in in a table format. Might be something we can share with our audience as well for next time. So that would be something good to share. So we are close to our 30-minute mark. I don't know if we have time to go deep into the investment side of things, but I don't know if there's anything you want to mention, a couple of things before we close for the day, but then we can continue the conversation next time, the following Thursday.
Yeah, no, I think what I wanted to mention quickly here is two things. One, and I know you and I have talked about this many times. So one, not to forget or to neglect your accounting. Remember that the accounting, whatever you put in is what you're going to get out, and whatever we get out of that is how planning is going to be done. So poor quality accounting will lead to poor quality planning. So
Absolutely.
you realize that's the source that's going to be used for planning, either be tax planning, investment planning, business planning, comes from that source. So do not neglect your accounting. And number two, do not wait or delay your tax planning. A lot of the decisions has to be not only calculated, but it has to be implemented. A lot of this prior to the end of the year to really
right.
So really, we don't have. I was talking to somebody else. Really, we do not have, let's say, 6 weeks left in the year.
True.
Yeah, really, what we have is about 3. Because again,
yes,
this week,
with the holidays.
Exactly. This week, people are not even thinking business; they're thinking turkey.
Yes.
They're comatose of all the turkey and apple pie and pumpkin. So they're comatose. So they're not really thinking of that. So then it comes Christmas, and then so there again. Really, we have about 3 weeks on productivity. So what I urge you to do is do not postpone tax planning until
absolutely. 2020. Yeah, absolutely. And then, we've mentioned that before too, that even if we were to start tax planning now, some items we won't even be able to implement until probably the following year, because, it's already, year end and we don't have enough time to implement everything. So the best way is to make sure you're giving yourself 3 to 4 months ahead of time, start the planning process, plan out when the timeline of implementation, because this doesn't happen overnight. Tax planning is not tax estimation. Tax estimation is very different, correct? We can always do a tax estimates if that is something that you'd like to do as well. So you can always reach us out anytime to do that. We can do a very a specific tax estimate based on your current needs, but tax planning is a very different thing. It takes a lot longer. It's a more detailed process, and it could take 4 to 6 weeks and more. So with that, we are already at the 30 minutes. Thank you so much for everyone that's been watching us, and we want to wish you happy Thanksgiving, and we shall see you next Thursday at 10 a.m. Yeah. Happy holidays. Happy Thanksgiving.
You too. Take care.
Bye.